When I first started day trading using ICT concepts, I would always be shocked when I would see a textbook model fail. I would see, market structure shift, breaker block, fair value gap, order block, and 5 other overlapping PD arrays on my screen, and the setup would still fail. It took me a long time to understand the true reason why I would see other YouTubers executing their strategies with high win rates. 60, 70, 80, 90% win rates. But no matter what I did, I could never reach their profitability. At some point, I started to believe that I just didn't have the feel for the market that these YouTubers did, and that I was hopeless. The turning point for me, it's not the same for everyone, of course, but the turning point for me was being able to understand where the market was going to go next based on liquidity, daily bias, and key levels, which is what I'm going to teach you today. So in trading, we always want to be trading with the momentum, right? We don't want to, if we just had 20 down candles and we suddenly get one up candle, we don't want to instantly go long. We want to wait for some sort of confirmation that the trend is changing. So in other words, we want to trade with the trend. I don't like to say the trend because in my opinion, the market doesn't really trend. It just seeks liquidity and rebalances fair value gaps. But that's something we can get into later. So in general, we just want to be trading what direction is the market going. So the first way that you can find this out, I actually don't prefer this method, but you can use IRL and ERL. So in ICT, his teachings, he says that the market only moves from external range liquidity to internal range liquidity. What does that mean? Well, internal range liquidity is a fair value gap, like I have marked out here. And external range liquidity is just any high or low. So we see this swing low. So what the market does is it cycles between going to IRL and going to ERL. So it'll go to IRL and then ERL and then and then IRL and then ERL. Sorry, I just got messed up. So here we have a pretty clear example where the market, it left this abnormal wick down here and it came up, rebalanced this big fair value area, fair value gap, and then came down and took out this ERL. And created new ERL. The only problem with this is that you can only use this method to find your daily bias or like whatever your trend when it's stupidly obvious. Most of the time, if you're just kind of eyeballing this strategy, the ERL, IRL, and you're just kind of looking, it's not always going to go in your way. So unless you have a stupidly obvious example like we do right here, I would avoid trading it like this. So if we've just gone over ERL and IRL and we're basically saying, okay, this is going to work some of the time, but only when it's really obvious, that means that we need another way to figure out our bias. So in this case right here, this is actually kind of a double example, but the next way that we're going to find our bias is by just finding important liquidity pools on higher time frames. So in this case, I used the 1 hour, but you can use any time frame, 4 hour, 15 minute, 30 minute, 1 hour. If you're intraday trading, just find your liquidity pool and target it. So in this example right here, we can see that we had this LRLR right here. It looked very nice for it to be run, right? So all the way down here, this is marked, this is open right here, 8 o'clock, and you can see that we kind of just ripped right through it. So, if I were here and I saw a textbook short, it had 20 confluences to go short, I still wouldn't go short because of this LRLR. It just looks so good for it to be run. We also have these equal highs above, which get run, at a later date. But in general, just find your most important liquidity pools, and once the market looks like it's going for them, you should target them. In my opinion, the best liquidity pool is equal highs, and then LRLR, and then data wicks, and then relative equal highs, and like London lows, London highs, stuff like that. Okay, so finally moving on to key levels, and a little bit about displacement. So in the last little video that I made about targeting important liquidity pools, that you just watched 10 seconds ago. I'm recording this later, but you just watched it 10 seconds ago. I kind of said, wait for the market to look like it's going for the liquidity and then target it. So that's kind of unclear. So I just want to clarify real quick what that means. So every time that we get to some key level, some high or low or some fair value gap or whatever it is, We want to look at the reaction to determine if we're going to reverse or if we're going to go higher. So obviously this doesn't work always, which you're going to see here in a second, but it works most of the time. Here we have this important level. What do we see? Price displaces through it quickly, forms this OB. So that should be enough to tell us that we're going to the next high, which, we took here, but then we have a later extremely bullish reaction. Should tell us that we're going to this next high. Then we break through it, bullish reaction straight through. We go to this next high, another bullish reaction straight through. This is where it gets kind of iffy. We get to this high and we kind of go down a little bit, but as you can see, just right back up, rallies up to the next high, more displacement. And then see, this is where the market tricks people, where it gives you this big displacement downwards after taking out some key level, just kind of faking you out. So that's why, for me, I never try to catch a falling knife. I guess in this case, what would this be? This would be an erecting, it's the opposite of a knife. I don't know. Whatever. I don't try to catch the very top or the very bottom, because you get burnt most of the time. I don't think the wins make up for the losses. Once you have confirmation, though, that market is reversing, up here, that's when you can go down and say, all right, what's the key liquidity down here? And you could say, all right, we've got some relative equal lows, right here. Maybe I can target those. Maybe I can target, this low or this fair value gap, whatever. It doesn't matter. The point is, when you see the market react, that's when you want to react. You don't want to be delayed. You don't want to be looking right here after the market has already dumped 10 points and say, oh, now I want to get in. That's not how it works. You need to react and change your bias or change your idea about where the market is going to go, all within a split second. Okay, so the final note about all of this stuff is that you are going to have the best market conditions, the most predictable market conditions, when you have all of these three things that I've just shared with you all in tune with each other. So I'm also going to be going over market maker models later, but right now, what did we just learn? Well, we just learned about ERL, IRL, key levels, and important liquidity pools. So if you have ERL, IRL, that shows that you're going to be bearish that day, but you have an important liquidity pool above saying that you're going to be bullish. Those are low probability conditions. The market doesn't know exactly where it wants to go. You want to trade on the days where everything aligns and you know that you are going to have, I'd say you should be above 90% certain that your idea for the day is going to work. Thank you guys for watching my second video about how I actually doubled to tripled my win rate. Like and subscribe if you enjoyed the video. I'm going to be pumping out more content like this for hopefully, the years to come. But yeah, I'll see you guys later.